Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, here we are. The bull market continues, and as this market continues to grind higher, there's no shortage of people calling for a top, sort of the idea that we've come too far, too long, etc. However, let me tell you one thing. Bull markets do not die of old age. Furthermore, it could be viewed that this bull market is not 8 years old, but more like 8 months old, that started post-Brexit in July, where 2015 was mostly a bear market. But again, that's how people view things. Anyways, but what do bull markets die of? They die of a recession or extreme euphoria, and we're nowhere near that. For instance, if we look at the leading economic index, continues to point to further growth. In fact, the most recent report on the leading economic index, it shows that we're at a 10-year high. Now, the leading economic index from the Conference Board always tends to turn down before a recession. So we're nowhere near a recession. We have a steepening yield curve, again, that's non-recessionary. So the question is, are we at euphoric? Meaning, is everybody just thinking this market's going to go on forever? I doubt that. As Sir John Templeton said, bull markets are born on pessimism, they grow in skepticism, mature in optimism, and die in euphoria. It seems at times we're almost getting past that optimism phase, but we tend to fall back below that, still growing on that skepticism phase. And the reason I say that is you can take a look at the National Associations of Active Investment Managers. They're actually now about 68% invested. That's the lowest it's been for the year. Furthermore, if we look at the American Association of Individual Investors, their bearish outlook, we're basically at about 38%. Those are levels that we see near market bottoms. Again, both of these indicators are contrarian, so again, not signaling any kind of a top. Now also, we can look at the economic outlook, and those surveys are very strong, meaning if we look at the Small Business Optimism Index, that's basically at a new high since about 2004. If we look at the CEO Roundtable outlook on the business outlook, that's at the highest levels recently surged since 2009. And if we look at the consumer confidence level, that's the highest it's been since 2000. So what we have is a good outlook on the economy, but a kind of more of a pessimistic outlook on the market, and that's a good thing. So now if we couple these things with the stability of households, we can look at the households leverage. Those are basically at 30-year lows, meaning the household's average household liabilities versus total assets, that's a 30-year low. So basically what we have is a market that's going higher, steady household, good business outlook, nowhere near euphoria, nowhere near a recession. So that tells us there's room for this market to keep moving higher. So, as always though, you want to let price and volume be your guide. Don't take anybody's word for it, but these are just things you should have in the back of your mind next time someone tells you that the top is in. Yes, we will have corrections here and there, but generally the long-term trend is still up, and we might have plenty more room to run. So as always, let price and volume be your guide. This is George Kachuk, RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great trading week.